The shooting star pattern is a technical analysis tool that suggests a potential bearish reversal in the market. It is characterized by a small body near the bottom of the price range with a long upper shadow, indicating that during the session, buyers pushed the price up, but sellers managed to bring it down close to the opening level. This pattern is significant because it signals that the buying pressure is starting to weaken and a sell-off may be imminent. Traders are encouraged to practice identifying the shooting star pattern in their trading activities. This involves looking for the distinctive small body and long upper shadow after a price advance. Recognizing this pattern can help traders make more informed decisions about when to enter or exit a trade, potentially leading to better outcomes. In conclusion, the ability to accurately identify and interpret technical patterns like the shooting star is crucial in the dynamic world of trading. However, it is also important to remember that no single indicator should be used in isolation. Continuous learning and adapting to new information and market conditions are essential for success in trading. By staying informed and maintaining a disciplined approach, traders can enhance their ability to navigate the markets effectively. Candlestick patterns are essential tools in technical analysis, helping traders and investors gauge market sentiment and make predictions about future price movements. Each candlestick provides a visual representation of price action within a specific time frame, showcasing the open, high, low, and close prices. The patterns formed by these candlesticks can indicate potential market reversals or continuation of trends, making them valuable for decision-making in trading. A particular pattern of interest is the long lower shadow, characterized by a candlestick with a small body and a long lower wick. This pattern emerges when the price dips significantly below the open, but recovers to close near the opening price, leaving a long shadow at the bottom and a small body at the top. The long lower shadow is often seen as a bullish signal, suggesting that, despite selling pressure during the trading period, buyers have regained control and pushed the price back up, showcasing potential strength in the market. Investors and traders view the long lower shadow as an indication of a possible upward trend or reversal, especially when it appears at the bottom of a downtrend. This pattern suggests that the selling pressure is waning and that buyers are starting to dominate, potentially leading to a rise in price. In the context of market analysis, recognizing such patterns can guide investment decisions, offering clues on when to enter or exit the market for optimal results. The long lower shadow is a candlestick pattern in financial charts that is considered a bullish signal, indicating potential upward momentum in the pricing of an asset. This pattern is characterized by a candlestick with a small body, which sits near the top of the candle, and a long lower wick or shadow that extends significantly below the body. The body represents the difference between the opening and closing prices for the period, while the long lower wick signifies a substantial distance between the low price and either the opening or closing price, depending on whether the market is moving up or down. In a trading scenario, the appearance of a long lower shadow suggests that, despite selling pressure during the period, buyers were able to push the price back up towards the open or close, thus showing resilience or rejection of lower prices. This can be seen as a sign of bullish sentiment, making it an essential pattern for traders who use technical analysis to foresee upcoming price movements. Visualizing this without actual charts, imagine a candlestick with a short body near its top and a long, thin line stretching down from the body. This formation, particularly after a downward trend, is seen by investors as a possible precursor to a reversal, indicating that buyers are starting to outweigh sellers. When this pattern forms during periods of market volatility or at the support levels, it's often closely watched by traders. They interpret it as a signal that, though the asset faced some selling pressure, there's strong buying interest at lower price levels. This scenario paves the way for potential upward movement in future sessions. In essence, the long lower shadow pattern provides key insights into market sentiment, serving as a valuable tool for investors looking to capture opportunities in shifting market conditions. A long lower shadow is a candlestick pattern in the context of financial markets and is indicative of a specific type of market sentiment. The defining features of this pattern are its shape, size, color, and the prominence of its lower wick. The shape of a long lower shadow is characterized by a small body at the top and a long wick below. This wick or shadow typically extends significantly from the body, suggesting that during the trading period, prices were driven down but subsequently recovered to near the opening level. The size of the shadow compared to the body is crucial. For a candlestick to be classified as having a long lower shadow, the shadow should be at least twice the length of the body. The color of the body can be either green or red. A green body indicates that the close was higher than the open during the trading period, while a red body indicates a close that was lower than the open. However, the emphasis is more on the long wick than the color of the body. The significance of the pattern's position within a trend cannot be overstated for accurate interpretation. When a long lower shadow appears at the bottom of a downtrend, it suggests bullish sentiment, indicating that selling pressure was overcome by buying pressure by the end of the period. Conversely, when it appears in an uptrend, it warrants caution as it can indicate increased selling pressure. Real instances of long lower shadows can be observed in different market conditions. In a downtrend, a long lower shadow might signal a potential reversal, encouraging investors to consider bullish positions. For example, if a stock has been declining for several days and then forms a candle with a long lower shadow, it might indicate that sellers are losing control and buyers are starting to dominate, potentially leading to a trend reversal. Similarly, in a range-bound market, a long lower shadow at support levels might confirm the strength of the support, suggesting that the price is likely to bounce back up. These instances help traders and investors gauge market sentiment and make more informed decisions about their positions. By understanding the specific features and implications of long lower shadows, individuals can better navigate the complexities of financial markets. The long lower shadow is a term used in technical analysis that describes a specific candlestick pattern on a price chart. This pattern is characterized by a candlestick with a small body and a long shadow extending downwards from the body. It signifies a scenario in the market where, during a given time frame, the sellers or bears initially had enough strength to push the price down significantly. However, the bulls or buyers entered the market with force, pushing the price back up to near its opening level. The long shadow thus reflects the depth to which the price fell before the upward momentum returned. This pattern is significant because it can indicate a potential shift in market sentiment. When traders see a long lower shadow, especially in a downtrend or at a support level, it suggests that the selling pressure that had been driving the price down may be waning. The buyers are showing resilience by pushing prices up from the lows, demonstrating a change in dynamics where buyers are starting to gain control. This can be interpreted as a bullish signal, suggesting that the market may be ready to move higher. Understanding what the long lower shadow signals about market sentiment and trader psychology is critical. Initially, the bears are in control, having successfully lowered the price. The long shadow, however, tells a story of a battle where the bulls have made a strong comeback, possibly overturning the bears' advantage by the end of the trading session. This interplay of forces is a vivid illustration of the constant flux of power between buyers and sellers in the financial markets. In summary, the long lower shadow is a visual representation of a specific moment in time where pessimism starts to be replaced by optimism, potentially indicating a turning point in the market. The long lower shadow is a candlestick pattern in financial charts that often captures the attention of traders and analysts due to its unique appearance and potential implications for market movements. This pattern features a candle with a small body at the top and a long wick or shadow extending downward, indicating that prices have moved significantly lower than the opening but have retraced to close near the opening price. Determining whether the long lower shadow signals a continuation of the current trend or suggests a potential reversal depends largely on the surrounding market context. Let us explore how this pattern can indicate both scenarios. In the case of a continuation pattern, a long lower shadow may appear during a downtrend, suggesting that although there was a significant attempt to push the price lower, the closing near the opening price shows resilience among buyers. This scenario can lead to the continuation of the downtrend if followed by a confirmation candle that closes lower, indicating that sellers are still in control despite the buyers' efforts. Conversely, as a reversal pattern, the long lower shadow can signal a potential bullish reversal when it appears in a downtrend. This suggests that sellers pushed the price down during the period, but buyers were able to overcome this selling pressure, closing the price near its open. If this pattern is followed by positive confirmation, such as a candle closing higher than the long lower shadow's close, it can indicate a shift towards a bullish market. An illustrative example of the reversal scenario can be seen in a chart where a security in a prolonged downtrend suddenly exhibits a long lower shadow candle. The market, previously bearish, shows this sign of buying pressure as buyers step in to push prices up from their lows, closing near the open. If the next few sessions reveal a series of higher closes, it would support the argument that the long lower shadow was indicative of a reversal. For a continuation example, envision a downward trending market that shows a long lower shadow candle, but instead of reversing, the following candles continue to trend downwards. This indicates that, despite the buying pressure within that period, overall market sentiment remains bearish, and the current trend is likely to continue. In both scenarios, the long lower shadow serves as a sign of potential change or continuation, but the subsequent market action is crucial for interpreting its true significance. Market participants often look for additional confirmation through other technical indicators or patterns to make more informed decisions. Understanding the implications of a long lower shadow involves observing additional indicators which can provide a more comprehensive analysis. Here is a closer look at these supporting factors. Trading volume plays a crucial role. A spike in trading volume on the day a long lower shadow appears lends credence to the bullish signal, suggesting that buyers actively stepped in to push prices up from the lows. Conversely, low volume may indicate a lack of conviction, weakening the pattern's significance. Nearby support levels also deserve attention. When a long lower shadow forms at or near a known support level, it reinforces the bullish signal. This correspondence with support suggests that the market respects these levels, providing a safety net that prevented further decline. The trend preceding the pattern is equally important. A long lower shadow emerging in a downtrend could signal a potential reversal, with buyers starting to outweigh sellers. If it forms during an uptrend, it might indicate continued buying interest, providing an additional layer of confirmation to the pattern's bullish implications. In summary, while a long lower shadow can be a bullish indication on its own, its significance is greatly influenced by trading volume, nearby support levels, and the trend preceding the pattern. High volume, the proximity to support areas, and the context provided by the previous trend can all strengthen the credibility of the bullish signal. Conversely, low volume and the absence of supportive context can dilute its significance. The long lower shadow is a candlestick pattern observed in financial charts, characterized by a significant shadow extending downwards from the candle's body, signaling a bullish scenario where buying interest outweighs selling pressure during a specific period. Its historical accuracy in signaling potential changes in market direction is notable, often indicating a shift towards an upward trend when appearing in a downtrend context. However, like all analytical tools, the long lower shadow has its limitations. Its reliability can be affected by market volatility and the presence of external factors influencing stock movements. Thus, it is crucial for investors to corroborate this signal with other analytical tools and indicators such as moving averages, volume analysis, and fundamental analysis to validate potential market movements. This multi-faceted approach enhances the accuracy of predictions and helps in the formulation of a more robust investment strategy. In summary, while the long lower shadow offers valuable insights into market sentiment and potential shifts in direction, reliance solely on this pattern without the support of additional analysis could result in misconstrued market interpretations. Incorporating it into a comprehensive analysis strategy is fundamental for making informed investment decisions. Integrating the long lower shadow pattern with other technical analysis tools enhances the precision and reliability of trading decisions. The long lower shadow is a candlestick pattern indicating potential bullish reversal, characterized by a price candle with a small body and a long lower wick. This suggests that despite selling pressure, buyers managed to push the price up by the close. When combined with other tools such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, or Fibonacci levels, traders can gain a more comprehensive view of the market. For example, when a long lower shadow appears in an oversold area below 30 on the RSI, this reinforces the bullish reversal signal, suggesting that the selling pressure might be exhausting. Similarly, if the long lower shadow coincides with a bullish crossover on the MACD, where the MACD line crosses above the signal line, it further confirms the potential for upward momentum. Lastly, if this pattern forms near a significant Fibonacci retracement level, such as the 50% or 61.8% levels, it adds another layer of support, increasing the confidence in the bullish signal. A real-world example could involve a stock that has been on a downtrend for several weeks. If a long lower shadow candle forms and simultaneously the RSI moves above 30, indicating the market is moving out of the oversold condition, and the MACD shows a bullish crossover, a trader might see this as a strong indication to consider entering a long position. If this setup occurs near a significant Fibonacci level, which acts as a potential support level, it could provide an even stronger case for the potential reversal. By analyzing these indicators together, traders can make more informed decisions, reducing risk and enhancing the potential for profitable trades. Common mistakes and misconceptions regarding the long lower shadow include overlooking the context in which it appears and disregarding the importance of volume. Traders sometimes assume that a long lower shadow is a bullish signal in isolation without considering the overall trend or the trading volume that accompanies the candlestick. This could lead to misinterpretation and premature decisions. To avoid these mistakes and refine pattern recognition and analytical skills, traders should 1. Analyze the context. Look at the long lower shadow within the broader market trend. A long lower shadow in a downtrend might suggest potential reversal, but it is crucial to confirm this with subsequent trading activity. 2. Consider the volume. High volume accompanying a long lower shadow can reinforce the significance of the potential bullish reversal. Conversely, low volume may suggest less conviction among buyers. 3. Cross-verify with other indicators. Use technical indicators like moving averages, relative strength index (RSI), or support and resistance levels to confirm the bullish signal suggested by a long lower shadow. 4. Practice patience. Wait for further confirmation in the next candlesticks before making a decision. A premature entry based on a single candlestick pattern without confirmation might increase risk. 5. Keep learning. Continuously educate yourself on candlestick patterns and market psychology to sharpen your analytical skills. This involves studying historical patterns and how they played out in different market conditions. By being mindful of these insights, traders can navigate candlestick patterns more effectively, reducing the likelihood of misinterpretation and improving their market analysis capabilities. Employing the long lower shadow in trading involves analyzing candlestick patterns to make informed decisions on entry and exit points. The long lower shadow indicates a period where the price has significantly dropped but then recovered to close near the open, showing potential buying interest or a support level. For setting entry points, traders look for a long lower shadow to appear in a downtrend or near a support zone, signaling a possible reversal. The rationale is that the market rejected lower prices, suggesting an increase in buying pressure. A common strategy is to wait for additional confirmation, such as a bullish candlestick or an increase in volume on the following days, before initiating a buy order. Exit points, conversely, can be determined by identifying weakening momentum or bearish patterns after entering a trade based on a long lower shadow. Traders may set stop-loss orders below the low of the long lower shadow candlestick to protect against significant losses if the market moves against their position. A vivid example involves a trader named Alex who closely monitored stock ABC, observing its descent towards a known support level. Upon noticing a candlestick with a long lower shadow forming at this critical juncture, Alex interpreted it as a bullish sign. The next day, a substantial bullish candle confirmed the reversal, prompting Alex to enter a long position. Over the following week, as the price appreciated, Alex monitored for signs of momentum loss. The emergence of a bearish engulfing pattern signaled it was time to exit, securing a profitable trade. This strategic use of the long lower shadow, coupled with confirmation signals and risk management techniques, exemplified a disciplined approach to trading based on technical analysis. Understanding the concept of a long lower shadow in candlestick patterns on trading charts is important for interpreting market sentiments. The long lower shadow is seen as a bullish signal, characterized by a candlestick with a closing price near its high and a long wick extending below the body, indicating that the price was pushed down but then pulled back up significantly by buyers. Now let's discuss variations and similar patterns. 1. Hammer. A specific form of the long lower shadow where the candlestick has a small body at the top with a long lower wick, resembling a hammer. This occurs at the bottom of a downtrend, suggesting potential reversal as buyers start to outweigh sellers. 2. Dragonfly doji. A candle with almost no body and a long lower wick. It's formed when the open, high, and close prices are nearly the same, with a significant price dip during the session that's fully recovered by the close. This pattern indicates a strong buying pressure after a sell-off, suggesting a possible upward reversal. 3. Inverted hammer. Similar to the hammer, but occurs in an uptrend. It features a small body at the bottom with a long upper wick, indicating that there was selling pressure which was overcome by buying pressure by the end of the trading session. Although resembling bearish sentiment, its occurrence in a downtrend can predict a bullish reversal. Each of these patterns provides unique insights into market dynamics. For example, a candlestick chart showing a hammer pattern after a prolonged downtrend may indicate that the bears are losing control and a bullish trend could be imminent. On the other hand, an inverted hammer might signal a potential bullish reversal during a downtrend, but only if followed by confirmation in the subsequent trading session. Interpreting these patterns together with the surrounding candlesticks provides a clearer picture of market sentiment. For instance, a dragonfly doji followed by a sizable bullish candle could reinforce the prediction of an upward trend. By contrast, without bullish confirmation, an inverted hammer might be a false signal. Learning to identify and understand these variations beyond the straightforward, long lower shadow can help traders make more informed decisions. Charts come to life when these patterns are recognized, revealing potential turning points and opportunities in the market.